what a wraparound mortgage does is it allows investors to structure deals with flexible terms. Now, I'm working on a deal right now. It's a woman who bought a house. At the time of purchasing it, she was married, and sadly, her and her husband separated and got divorced. Well, in the divorce, she got the house, okay? Now, the house is, it's a fine house. It's nothing spectacular. But what is spectacular is she bought the house back in 2020 when interest rates were really low, and she has a first mortgage at 2.65% interest, okay? Now, what we're going to do with her and her house, she's going to sell that house and she's going to offer seller financing, okay? Now, she's going to price that house at $600,000. She's going to ask for 20% down. Now, 20% down on $600,000 is $120,000, which means she's going to be financing $480,000. Now, she owes $220,000 and she has a mortgage at 2.65 on $220,000. She's going to finance $480,000 at a 7.99 rate, which is pretty good in today's market. Anything less than 8 to somebody who may not have great credit or challenge credit or a small monthly down, it's a great loan for them. Now, she's going to wrap the mortgage that she has at 2.65. She's going to seller finance to the new buyer at 7.99. Now, the delta between what she's paying and what they're paying ends up being almost $1,500 a month. And we simply set that up with a servicing company who collects the monthly payment from the buyer, makes a payment to her lender, and then cuts her a check for that $1,500 a month. Now, guys, if you do the math, $1,500 a month for 12 months is an extra $18,000 a year. And when we do seller financing and subject to deals, we write the paper at 30 years, which means she's going to get $1,500 a month for the next 360 months. Now, what a great deal for a single mom who's now living on a single income, where before she was just going to sell it and hopefully get something out of it. Doing this, using this wraparound strategy, she's going to have an extra $1,500 a month that she wouldn't have had before. Now, as I mentioned, the buyer makes payments directly to the seller but gets the deed after full payment. This is a contract for deed or a land contract. And these are really popular in markets where bank lending is tight.